This week, critical economic events occurred, and it's really important that we understand their implications. And this has possibly set the tone for the foreseeable future. Today, we're going to discuss the gross domestic product, personal consumption expenditures, University of Michigan consumer confidence. We will show you how the GDP report indicates the economy has more than enough strength to sustain itself under our current high interest rates. You're also going to see the Fed's favorite measure of inflation, and that is as sticky as ever. Also, consumer sentiment is strong, and we're going to show you how relevant that indicator actually is. This week's economic calendar in particular is crucial, as it directly speaks to the two key factors that the Federal Reserve uses in setting interest rates. Economic growth best illustrated by GDP and inflation. For inflation, we're going to analyze the Fed's number one favorite economic barometer. On the basis of these economic reports, the Fed will set monetary policy, which in turn will go to influence not only stock market trends, but also affect every facet of our financial lives, credit card rates, mortgages, and overall business conditions. The second revision to the quarterly GDP was released. The economy is now confirmed to have grown by 3.4%. With the exception of the prior 4.9% report, the current quarter represents the best number we've seen in several years. Why is this important? With this rate of growth, the Federal Reserve, by their own words, is in no position to cut interest rates. Also reported this week, the University of Michigan Consumer Sentiment Report, a survey that measures the expectations of consumers regarding the U.S. economy. With a current ranking of 77, this represents the second best figure we've seen in several years as well. The benefit we gain from this figure is the understanding that consumer sentiment is parallel with the rate of economic growth. An optimistic consumer spends more, and in turn, this commerce benefits corporate earnings. The University of Michigan also publishes their inflation expectations. This has declined to 3.0, the third consecutive month in this area. We're going to see in just a moment how closely inflation expectations track with the actual rate of inflation. Interesting to see how the consumer has a good read on the economy. What was the actual inflation data? The personal consumption expenditure, PCE, was reported. Current indications now stand at 2.5% on a year-over-year basis, and the Fed's preferred measure of inflation that is most closely tracked in setting monetary policy, the core PCE, which excludes food and fuel, the more volatile and seasonal components of inflation. Current annual readings now sit at 2.8%, just a hair below last month's 2.9%. While the downtrend is progress, we have yet to achieve the Fed's goal of an average and sustained 2% rate. Putting the two measures together, the core PCE displayed in histogram bars and the Michigan inflation expectations in white. Over the long run, the consumer's expectations do in fact correlate quite well with the actual rate of inflation. Again, there's a benefit in recognizing our expectations do tend to mesh with the actual economics. How we feel determines how we spend, save, and invest. Our collective financial decisions go to determine the trends within the markets and the overall economy. Now let's shift gears to the Fed. And what we're going to show you is kind of an unusual approach, which I think you'll find quite interesting. The Fed funds futures are financial derivatives traded on the Chicago Merc, also known as the CME. Among the many purposes is to determine the market's expectations of monetary policy. We're going to show you specifically the probability the Fed will not change rates. We're going to compare one meeting to the other. Putting this data together tells quite the interesting story, and I think you're going to understand exactly where we are now. So let's begin with the Fed meeting we just had in March. The blue line shows the odds the Fed was not going to change rates. The x-axis below shows us the number of days before the actual decision. Here the arrow is pointing to the point in time about 30 days before the actual Fed meeting. The y-axis on the right-hand side shows us the probability the Fed will not raise or lower rates. The higher the number, the less of a chance of any change. So, in this particular case, about 30 days before the March meeting, there was already a 90% probability the Fed was not going to change interest rates. Just like all of us, the market was also watching inflation and growth reports, and they guessed correctly. Now, here's where it gets really interesting. The yellow line shows us the market's expectations the Fed will not change interest rates in the May meeting. At the moment, we're about 30 days out from the next Fed meeting in April 30th, May 1st. And this is showing us the May odds are tracking pretty closely with where we were at this point 30 days before the March meeting. What's really interesting, notice the divergence between the March and May odds. The odds the Fed will not change rates in May rose faster than in the time leading up to the March meeting. What can we take away from all this? What's the difference between where we were 30 days before the March meeting and now 30 days before the May meeting? Well, actually, two key factors. Inflation is now stickier. We just saw the core PCE, the Fed's favorite gauge of inflation, still stuck at 2.8%, and it just refuses to give up. Meanwhile, the economy is strengthening. We started off today reporting a 3.4% GDP, the second best figure in several years. In fact, there's currently a 96% chance the Fed will not cut rates in May, and given sticky inflation and strong GDP, it certainly seems appropriate. So, what's the next step? In June, where do we stand? Shown in red, the expectations of no change in rates in the June Fed meeting. Currently, about 75 days before the June meeting, there's a 36% chance of no change. We can see the June odds are on pace with where we were at the same time before the March and May meetings. So, what does all this data tell us? What can we learn from this? Moving forward, what's next? Economic growth is strong. The GDP confirms it. The Fed has no reason to cut rates. The economy does not appear to need the stimulus. Inflation is sticky, especially according to the Fed's preferred gauge. The Fed has been quite consistent in reminding us that rate cuts will only occur around 2%. This environment, for the better or worse, seems to be favorable for stocks, which are flirting with new highs almost on a daily basis. And barring any change in from what we've discussed, the trend is your friend. Of course, no trend lasts forever, but the current data also does not give us any reason to expect a different outcome. Next week's economic calendar, of course, provides us with more data, including construction spending, factory orders, a slew of Fed officials that are scheduled to speak, and the ever important jobs numbers. We spend a lot of time discussing the Federal Reserve, and for good reason. Their decisions as to monetary policy affect every facet of our financial lives. Interest rates impact our decisions to spend, save, invest, all of which create the long term economic trends and overall tone of the markets. So we commit ourselves to the study of economics and to study the winds of finance and monetary policy, for they carry secrets not yet discovered. Armed with this data, knowledge, and experience, we charge forward, navigating the ever changing sea of economics and opportunity.